And this is like if you're a little bit of a stock nerd, or you want to be, or you're thinking about researching, or you're looking at a stock screener, because a lot of people do. And so if you're this person, write these down. These are going to be things that you're going to look for. And I'm going to give you a couple of little tools that you can use, most of which are free to just go use and look at and start to get yourself familiar with. These are the key indicators that you want to look for when we're shopping for value companies. First thing we're going to look for is a lower price to earnings, or PE ratio, than the industry average. And so a lower price to earnings ratio is key, because it means that you possibly have an asset that is trading below its actual value, or it has the ability to make up room to come to a higher earnings to match the rest of the industry. So that's what you're looking for. That's the first sign of a discount. Second is a low price to book ratio. And so this is what's the book value, the asset value of the company, and what is it trading for compared to that ratio. If it's trading below its actual asset value, or it's trading below the book value, you've got yourself a deal there. And again, these are all things that you can find on stock screeners, or you can Google, or you can put into ChatGPT or DeepSeek, or any of the other AI models that are out there. They can pull this information for you, and get very sophisticated and very precise on which companies match these criteria. Number 3, strong free cash flow. I'm a big fan of free cash flow because it shows that a company generates enough cash to not only fund its growth and return value to shareholders, because it enables them to have options. And so a company with high free cash flow can pay a dividend. They can buy back stock, which raises the stock price. They can expand, which adds to value over time. They can go out and acquire a competitor, which is accretive value. And so there's a lot of great things that happen with free cash flow. I love free cash flow. It's a hallmark of good value investing. Next, you're going to look at the debt to equity ratio, just like on your personal balance sheet. Lower debt means more financial stability. So if you find debt ratios that are very manageable and very low, those are the companies that you want to go for, because it means that those, again, are companies that are generating strong cash flow, but maybe trading below their value. Now you want to look for number 5, high return on equity, or ROE, and a high return on invested capital.